Welcome in, folks. Hope everybody's having an absolutely phenomenal day out there here today. We've got a few things I want to react to in this video. First one up here, I saw this on X this morning. I said this would be perfect for me to react to. This gentleman, Antonio, talks about he's betting his entire portfolio on these 5 predictions, these 5 stocks. We're going to go through the 5 stocks in this video, and I want to share my opinions, perspectives, if I like these stocks, if I don't like these stocks. So that should be a fun one to react to and kind of share my opinions and perspectives there. And then after we get done that, we're going to react to this little clip here on CNBC from a few days ago. The idea that you could work longer if you didn't save enough is just not true. I think it's an important subject. We don't really talk that often about retirement and those sorts of things on the channel, so I thought that was an important subject that we'll go ahead and discuss in this one here today. Okay, appreciate y'all joining me as always. I just want to get straight into this one. Thanks for being here. All I ask in return, hit that like button and make sure you subscribe to the channel. It takes less than 3 seconds. I appreciate each and every one of you. It helps out the channel tremendously. Okay, so first one up here, I'm betting my entire portfolio on these 5 predictions. Okay, so let's get into these 5 stocks. First one he mentions is Hims. It says Hims will become one of America's largest healthcare giants, serving as a deflationary force in a typically inflationary U.S. healthcare sector. Okay, so I mean, you know, this is a big statement. The thing that is so big with this statement is like mentioning about Hims being a deflationary force, because that's almost like bigger than just like betting that Hims is going to be a great stock and be a stock that can 5x or 10x or 20x over the next, decade or whatever, right? The fact that you would, make a prediction that they're going to actually serve as a deflationary force, I feel like that's a big prediction in itself, right? But I want to focus on the stock. So first off, in my opinion, Hims wants to be, in my personal opinion, like for the next 30, 40, 50 years, they want to be like Walgreens and CVS were for the last 30 or 40 or 50 years, but they're a new age business model, right? They're all online. You can do it all on your phone, right? And so very different than the Walgreens or the CVS experience, which was like actually going to a physical store, going through the drive-through, things like this. This is products that can be delivered to your house, right? So my opinion, Hims really wants to become a overall potentially pharmaceutical giant, but really I think they really want to become what Walgreens and CVS has been for previous generations. That's my personal opinion. Okay, now as far as the company goes, right, and the valuation, all those sorts of things. So let's go ahead, let's look up Hims here on 1000X and kind of see where we're trading at valuation wise on this one. So the companies looks like they're just about to start getting to profitability, right? I actually think they did go profitable, if I recall, in the last quarter or two. So forward P obviously looks astronomically high, and then even a 2-year forward P looks astronomically high. But, if you're just getting an infant stage of profitability, like you have a long runway ahead over the next 5, 10, 15, 20 years. So companies can eat through that forward P, that 2-year forward P very, very quickly, right? And so that's just something to kind of keep in mind there. Also, as far as EPS, next year EPS growth is expected to be triple digits. As far as trailing 12-month revenue growth, looks great, right? Great. Current year expected revenue growth looks phenomenal. And then next year revenue growth, as far as what analysts have here, not quite as exciting, but that's still great growth, right? So Hims certainly has the growth, right? Gross margins look great for this company, and then net margins, they're just starting to get to profitability, so that net margin should increase, I would say, quite dramatically over the next, we can say, 3 years, 5 years, those sorts of things, right? So that's good. As far as trailing 12-month price to sales ratio, forward price to sales ratio, we can't really compare those really, unless we're going to compare them against other companies. But you can't really compare them against a Walgreens or a CVS because those business models are drastically different than Hims, and the life stage of those companies is drastically different than Hims, right? So I just think that would be a bad comp, just to be quite frank, okay? As far as advanced metrics for this company, last year revenue growth was phenomenal. Trailing 12-month versus next 12-month revenue growth of a 35% rate there. On a 2-year stack, expected revenue growth, 71% there. Looks very good. So overall, I think Hims is if I had to say, the reward potential is pretty high with Hims, right? The reward potential is pretty darn high. It's a $4 billion market cap, right? And if they can become what Walgreens used to be in terms of that giant, right? And they can become what CVS has been over time. I mean, my gosh, we're talking about a company that could grow into, a $50 billion market cap or $100 billion market cap long term, right? So the reward potential for the HIMSS is absolutely sky high. However, we do have to be honest. There is some risk with this stock, right? There is certainly risk. Like, what if Amazon? Because I feel like we're still at a stage where if Amazon really wanted to go hard in this category, I think they could, if they wanted to, right? But does Amazon want to really get in here? I think Amazon's got to get in. When I say I'm talking take this super serious, like HIMSS is taking it. I think they got to do it in the next 24 months. If they do it in the next 24 months, I think that's a huge competitive threat for HIMSS, and I think that could potentially hurt future growth rates and where their brand position is and things like that. But if Amazon doesn't really get super serious about this in the next couple of years, I think HIMSS could be looking actually relatively lower risk if that doesn't happen. But for now, I think that's a big risk factor. And then certainly, obviously, the forward Ps and those sorts of things are a risk factor with the stock as well. You got to understand the stock could hit 50% quickly. It could go from $20 to $10, if all of a sudden some growth rate wasn't there or something like that. So it's just something to keep in mind. But for the long term, I like it as a long-term play. I don't personally own the stock, but I got to say, I could understand why folks own this stock. It's a very exciting long-term opportunity. And if now they're getting actual profitability, it makes things a lot less risky when you start to get to profitability. Because then that takes out the worries about bankruptcy and, bleeding of money, and we're going to have to raise money and dilute shareholder value. It takes all that out, right? So yeah, HIMSS is not bad at all. Alrighty, next one up here. What is this going to be? Well, look at that. Palantir. Palantir will transform into the foundational platform for new enterprises, becoming essential for building businesses from scratch. That is another interesting prediction that I just haven't heard a lot of people really go there. And, I'm obviously a pretty good Palantir shareholder. I got $100-something thousand in the public account invest in Palantir. I've never described it as really becoming essential for building businesses from scratch. I can tell you that much. I really look at Palantir as being at the cross-section of data and artificial intelligence and helping government agencies, the military, helping corporations make much better decisions with their data, right? And at the end of the day, that's going to save lives, it's going to save money, it's going to potentially make you more money if you're a company, right? Those sorts of things. So that's an interesting, I would say, way of describing Palantir, right? Now, in regards to Palantir, we're dealing with a little bit of a HIMSS situation in terms of, right? And by the way, the analyst in the 2-year forward P, I think that might be off, my personal opinion. I think it's actually lower than kind of what they have it and kind of, what we're running as far as analyst estimates there. But, you look at trailing 12-month EPS growth, obviously to the moon, triple digits. Current year expected earnings per share growth of 40+%. Next year earnings per share growth, 20+%. If you look at trailing 12-month revenue growth, a little slower, but now growth rates are starting to pick up, right? We're going to, 23%, is that possible for this year? I think that's definitely a possibility. Next year, revenue growth expected around 20%. And the way people are starting to think about Palantir is like a 20%-ish revenue growth story a year, right? Which I think is actually a relatively safe assumption for Palantir, given the positioning of the business. But I do think there's still potential this company could be at a CAGR of, compounded annual growth rate on revenue of 25 or 30% for this next 5 to 7 years. I still think that's actually a possibility. I think 20% is much safer prediction, but I wouldn't rule out a 25% CAGR or even a 30% CAGR over the next 5 to 7 years, right? Imagine an economy that's better and much stronger than certainly the one we've been going through over the past few years with inflation and all the uncertainty, right? Imagine a scenario where Palantir continues to innovate, come out with new game-changing products and services, and AIP continues to build out, right? I mean, I don't think it's crazy to imagine a 25 or 30% CAGR for this company. Gross margins are astronomically high. We all know that, right? Net margins have picked up considerably for this company recently, talking about 16%. Net margins for this company long-term can go to 30% in my personal opinion here. I think we got a long way when it comes to net margin growth for this company overall. So when I look at Palantir, no tears come to my eyes. I mean, it's absolutely, a beautiful stock. Is it as attractive of a potential investment as it was 2 years ago? I could make an argument that it's almost as attractive. Now, obviously, the share price is way up from there, right? It's, back then, we're talking a couple years ago, the stock was in the $6 to $10 range, right? It's $23 now. But if we go back a couple years ago, Palantir was far riskier. At that point, they were losing a lot of money, right? They didn't have as good of a balance sheet. They still had a good balance sheet back then, but it wasn't as good as it is now. It's even better. Their positioning in the market wasn't as strong as it is now. So although Palantir stock is $23 versus $6 to $10 a couple years ago, I can make an argument that it's a far safer stock now, right? And maybe the risk reward profile is even better now than back when I was buying it a couple years ago, right? So just a little food for thought in regards to that, right? By the way, 1000xstocks.com. If you want access to that or to apply for access to that, I'm going to put that as the pinned comment down there today. www.1000xstocks.com is where you can see all this stuff I'm showing you here. You can also compare 3 different stocks against each other, which is probably my favorite feature, and I think that's most people's favorite feature out there that are using the service so far. And then also we have the earnings calls on here as well, and so you can type in whatever ticker symbol you want, listen to our conference call, speed up the conference call if you want, 1.5x speed, 2x speed, whatever. Listen to transcripts or read the transcripts and all those sorts of things. So pretty darn phenomenal. So that will be the pinned comment down there. Next stock up here from Antonio is AMD. AMD will rival NVIDIA's dominance by leveraging its long-standing expertise in chiplet technology, which NVIDIA will eventually have to fully embrace. So, big statement there once again. I think it's possible. But I don't know, man. I don't know. Thinking NVIDIA is going to have to follow AMD, it's always a potential. I'm just not convinced of it. That's what I'll say about that. That one's and I feel like all these are kind of a little bit of stretches, right? Deflationary force, becoming essential for building businesses from scratch. I feel like all these are very big statements, and if even one of them comes true, that's pretty huge, right? But I don't know if I really buy into this one. As far as AMD goes valuation-wise here, it's not crazy, right? 2-year forward P looking at 27. If things go a little better than expected, that might even actually be lower than where it's at there, right? Earnings per share growth expect to start picking back up very nicely versus trailing 12-month earnings per share was literally going down for the company, right? So everything's going to get back on track with AMD's business model here, but they need to be posting better numbers like this. Like current year expected revenue growth, 14%, like put me to sleep. Like, look at NVIDIA's numbers and then look at AMD, right? I mean, gosh, these companies are like not even in the same ballpark, right? And I mean, look at the expected earnings per share growth. And remember, AMD was struggling all last year while NVIDIA was tearing it up. So look at trailing 12-month earnings per share growth. For AMD, it was down while NVIDIA was already blasting higher. And then NVIDIA is going to destroy AMD again this year, right? And then it's expected that starting next year, AMD can start beating NVIDIA when it comes to earnings per share growth. But we got to see that, right? And obviously, law of large numbers is going to catch up with NVIDIA, certainly at some point in time, right? But look at the revenue growth differences between AMD and what happened there last year, or in the trailing 12 months, versus NVIDIA in the past trailing 12 months. It's triple-digit growth for NVIDIA. They're just destroying these guys, right? Look at the current year expected revenue growth. I mean, my gosh. So AMD, I understand it as a play, and a lot of people want to play this, but I think also a lot of people just trying to get a little slick with it and trying to think like they could outperform, NVIDIA by buying AMD now. But remember, AMD stock has gone up a lot. It wasn't that long ago, guys. The AMD stock was $50-something a share. And now it's $160. Isn't AMD like $160 now at this point in time? So it's not like AMD's been a lagger and the stock hasn't done anything for the last year or two. Yeah, $167. AMD stock, even though their results have been awful for the past year, their stock price has still gone up dramatically from 50 something dollars to $167, right? So it's not like that stock's been doing nothing while, everything else is doing phenomenal. So I don't know, those are just all things to kind of factor in here. And, maybe he's right on this, but I do think that's, we'll see. We'll see about that. It's a little harder to run, right? Spotify will secure its role as Google of audio, becoming a go-to platform for music streaming and all things audio. Margins will rise meaningfully as a result. So, I gotta be honest with you guys, I don't like this one. No, not my cup of tea. I feel like there's a lot better opportunities in the market than Spotify. I've never liked Spotify. I don't like Spotify. No. So when you're, it's not like you're getting it for a cheap valuation, right? You could look at a forward P 70 plus, 2-year forward P 50 plus on this one, right? Earnings per share growth next year should be very nice for the company. And revenue growth is decent for this one, but it's not like you're getting some extraordinary revenue growth company considering you're paying that sort of premium valuation. They're so reliant on streaming licenses. I used to own many years ago a company named Pandora. It was ticker symbol P back then, and then if I recall, they got bought. They sold themselves to, who did they sell themselves to? Oh my gosh. Was it iHeartRadio or something? I can't remember. Pandora ended up selling themselves. And that was that. But the problem with Pandora, they always had to deal with basically these streaming music rights and the royalties that essentially get paid to the artists and the producers and all these sorts of things. And every few years, basically, the licensing would come up again, and then it would have to get renegotiated, and it would kill off profitability. And so I worry that Spotify is going to have to continue to deal with that. And then as far as looking at it from like a podcast play, I don't like it, man. I don't like it. So just not a stock that's even remotely interesting to me. No. Not even. Too many problems and not enough good things in my personal opinion. So definitely don't like Spotify. Next one up here, Tesla. Tesla will revolutionize global material production, achieving abundance through ultra-efficient manufacturing, low-cost energy, and large-scale AI deployment. That's a big statement there, right? All these are pretty big statements. So obviously everybody knows I've been a Tesla shareholder for a long, long time, right? I think I bought my first shares in maybe 2018 or 2019. And I still have a tremendous amount of belief in Tesla for the long term. Obviously, this past year has been tough for Tesla as far as their numbers, their growth rates, as far as what they're going to report over this next, couple quarters here. But that's it. It's the short term versus the long term, and I believe the long term is intact. And also, if you look at analyst projections and things like that, analysts also believe this is just kind of a short-term phenomenon. Next year, revenue growth is expected to be very strong for this company overall, right? Gross margins, in my opinion, should start to pick back up in the back half of this year and then increase from there. Same thing with net margins. I believe net margins will start to increase again in the back half of the year and then especially start to increase in 2025. As far as earnings per share growth, we should get back to a very nice earnings per share growth with this company overall. So, yeah, you've got to differentiate between the short term and what Tesla's gone through versus the 5-year, 10-year opportunity, right? And the 5-year, 10-year opportunity is massive for Tesla. The 5-month opportunity isn't as exciting, right? And so that's kind of what you got to, in my opinion, differentiate between the two. Okay, alrighty, guys. So now that we got through all that, right? And so just to recap that, by the way, HIMS I think's okay. Palantir, I love that one. AMD, AMD I think is an okay stock. I think it's fine. It's just I hate this whole notion about it's a better buy than Nvidia just because maybe the stock hasn't gone up or not as much or the numbers haven't been as good. Stock's actually still done really good. Spotify, don't like that one. Nope, not even remotely interesting. Tesla, I love for the long term. It's just they got to continue going through this kind of short term, not fun cycle they're going through, right? Alrighty, let's get into this one. The idea that you could work longer if you didn't save enough is not true. We'll talk a little bit about retirement and all those sorts of things.
Welcome back to Squawk Box. Some experts already sounding the alarm about America's retirement crisis, saying it is nowhere near enough for many people facing retirement. BlackRock Chairman and CEO Larry Fink talked about this very issue in his annual letter to investors earlier this year, suggesting it may be time to rethink the retirement age of 65. But our next guest says the call to work longer is misleading, and a thesis that she now outlines in her latest book, Work, Retire, Repeat, The Uncertainty of Retirement in the New Economy. Teresa Gildarducci, I apologize.
Gildarducci.
Thank you.
You're not the first one.
And focusing on retirement.
It's a Gildarducci. Come on, man. Gildarducci, papi. Come on.
Of course, a professor of economics at the New School for Social Research. Good morning to you, and congratulations on the new book. Walk through your thesis and maybe how it differs with what I think a lot of folks are saying about how we may all have to work longer.
Yeah, so working longer is more of a convenient untruth, than any kind of plan or analysis. First of all, you hear that everybody's living longer, so why can't we work longer? Not everybody is living longer. The longevity gains over the past 40 years have mainly gone to the wealthiest Americans. Men have gained a lot more years of life than women, and in some segments, life expectancy is going down. And also, living longer is not the same thing as being able to work longer or being more attractive to an employer. Half the people who are retired say that they didn't retire, they were retired. They were pushed out of their jobs because of a layoff, a reorganization, their own health, physical or mental, or the health of their spouse forced them to withdraw from the labor force. We saw huge exits of older people. And I'm not talking 60s and 70s. I'm talking people in their 50s. Only half of people between the ages of 50 and 65 have continuous employment. So this idea that if we didn't save enough, we could actually work longer is a canard. It just isn't true on its face.
So if you're right, but people are physically living long.
So this is back in 2019, so it's a little outdated information they're showing here. But households with retirement account savings classified by age, 55%, 54%. Interesting.
Even if you think they can't work longer, then what would you do? I mean, the economics of that are very dangerous.
Right. Fortunately, most Americans don't want the government, just to pay for their retirement plan. Whenever they're asked, do you want to cut back on Social Security? Do you want to work longer? Or do you want to save more for your retirement? People choose, I want to save more for my retirement. Many people, when asked, would put more money towards their Social Security so they could get more Social Security money. So what is important to realize is that people feel that they need to save for their retirement, but they need a safe, effective, automatic platform to do it. The 401k system just doesn't cut it. We've run this experiment for the past 40 years. 40 years ago, 401ks became the more popular way that some employers, the employers who chose to, would provide retirement accounts. But now, after 40 years, only half of people at any one point in time are even in a 401k type plan or even an IRA or a traditional plan, which is becoming a teeny part of retirement coverage. So at any one point in time, half of the workforce is not saving for retirement, and when asked, they want to. So we need actually a bold proposal to get help everybody save for their retirement.
So how do you feel about it?
So I think the problem is, my personal opinion on this is, right, as somebody that's 34 years old now and has cared significantly about money since I started really learning about the subject when I was 18, 19 years old, right? My opinion is the whole pitch is bad. saving for retirement, I just don't think is an attractive pitch. I think people need to be thinking about the younger you get started investing and saving, right? But mainly not just like saving money to put away. Like it's really about investing that money and getting gains on that, right, over time. I think the pitch should be about putting yourself in a position of power throughout your life. It's way bigger than just worrying about, oh, I'm going to be 65 someday, I'm going to need to retire, and here's my money. I think that's not a very attractive selling proposition. I think it's about putting yourself in a position of power throughout life, throughout your lifespan, right? And so to kind of put it to you like this, the reason I was able to leave Quick Trip when I did, right, was enjoy my firstborn son's first year of life, was because I was in a position of power. I had $200,000 in stocks, right? The reason I was able to start my real estate marketing company and become an entrepreneur is why? Because I had all that money saved away from my investments, right? And so I've put myself in a position of power that I can do this, I can do that throughout my life. Versus just kind of thinking about it in terms of like we're saving up for this day when we're 65 years old or 75 years old or whatever, right? And so I think that's what it's really about. It's about getting people to think about the next 5 years, 10 years, 20 years, and starting to live life on your own terms and be able to make decisions when you want to make decisions, and you don't want to have to be stuck. You don't want to be stuck in situations like stuck in a job you hate. And you can't make a move out of that because you don't have any money. And so you're like, crap, I got my mortgage, I got my car bill, I can't do anything, right? You also don't want to be one of those people that, I know it's become popular as like, oh, I'm just going to rent and just going to live in my car or whatever like that, and try to have no financial responsibilities. I don't think that's the answer either. I think it's about like being able to make your own decisions out there and not being victim to have to be like, I have to do this, I have to do that, and just kind of as you go along with life, be like, you know what, I want to do this. Like, I put myself in a financial position. Like, if I didn't want to work for the next 5, 10, 20, the rest of my life, I don't have to. Great. Put myself in that financial position, right? A lot of work that went into that, and it is what it is, right? So if all of a sudden I'm like, you know what, I don't want to record YouTube videos anymore. I don't want to run the private stock group. I don't want to do 1000X stocks, whatever. Like, boom. And I just want to go sit on the beach for the next 5 years. I can do that, right? That's what it's about to me. Putting yourself in that financial position to then be able to do what you want. Like 1000X, why was I able to do 1000X and create that service? The reason being is because we got obviously got a chunk of money over here. And so if I say, I want to go build this service, I want to do this thing and build this thing that hasn't been built before, we can go do it. That's what it's about. To me, that's what it's actually about. And quit thinking about like, I need to save money so when I'm 65, I can get to it. And when I'm 74, I can get to it. And when I'm 83, I can get to it. And I can go to the Long John Silver's. Isn't that what it's called?
Social Security.
How do you feel about forced savings?
Sizzler.
Australia, a 401k plan that's a requirement.
It's actually the only way that countries, advanced capitalist market economies, have found that people will be secure in retirement. A universal pension system, just like our universal Social Security system. I'm in favor of mandatory savings, just like I'm in favor of mandatory Social Security. Why? It's not because I'm ideological about it. It's because practically it's the only system that works. We know that the most important power, financial power in our markets is the power of compound interest. Getting people in early into a pension plan is about the only way that they could have enough savings at the end of their working lives to supplement their Social Security. And, if you start...
I think her number's way too low. Say 5% of your wages? Come on, man. Like, you need to be double digits. Everybody needs to be double digits out there. Everybody needs to be double digits. You got to cut down on that lifestyle inflation. Problem is a lot of people let lifestyle inflation creep up. And then 5%? A little adjustment in pay downward at your workplace or a few hours cut, then you have nothing. That's why you always need to be double digits. You need to be minimum, absolute bare minimum, 10% of your wages should go toward investing. So if you have a salary of $100,000 a year, $10,000 minimum, bare minimum, needs to be going into stocks. And that's pre-tax, your pre-tax income. So if you got $100,000 coming through the door, right? You can say $30,000 going to taxes, so you actually got $70,000. Still $10,000 plus, right? Needs to be going toward your investments in that year. And if it's not, then you've got to bring down that lifestyle, right? But I can say it's a lot easier to just not bring up your lifestyle than bringing down a lifestyle. No one likes to bring down their lifestyle. So the trick is to not let that lifestyle inflation creep up on you, so then you aren't in a position where you're like, crap, man, I live in this apartment or this house, and now I got to live in something that's not as nice, or I drive a nice car, and now instead of driving a Model 3, I got to go drive a 15-year-old Toyota Corolla or something like that, right? You don't want to stick yourself in that position. It's easier, much easier mentally to just not let lifestyle inflation creep up. And 10% minimum pre-tax needs to be going toward investments.
Is about the only way that they could have enough savings at the end of their working lives to supplement their Social Security. And if you start saving in your 20s and 30s, most of that income you're going to live off of in your 60s, 70s, and 80s will come from the market, not out of your own hide. So it's saving 5 to 15% for every paycheck starting at age in your 20s or 30s is actually not a radical idea. It's just radical in the United States. And there is a bill in Congress.
Teresa, we're gonna have to jump in 1 second, but let me just ask you one final question, which is, at a time when there are so many Americans, especially lower down the ladder, who need the cash today just to get by, this is a counter argument effectively to the forced savings. By the way, I'm with you. I like the forced savings in concept, but the practicality may be very difficult.
You're going to have hamburger helper without the hamburger for the next 5 years, so that we can afford.
So that's exactly right. So lower income workers, under this plan in Congress, the Retirement Savings for All American Act was supported by Republicans, Democrats, and the AARP, Charles Schwab, Uber. And other platform economies say that if people are forced to save and they're low income, that money would go into their own account, and most low-income workers actually want that. And the government, under this plan, the government for lower-income workers would match that money by 5%. It would cost some money, but right now we spend billions for the high earners.
That's a good point. Good point, right? And at the end of the day, sometimes sacrifices have to be made. That's life. I hate when people get on TV and they act like people can't sacrifice. You know what I mean? Like, dude, I've sacrificed so freaking much in my life. Eating Totino's pizzas and ramen noodles and doing whatever I had to do, right? Meal prepping and, shopping at Walmart trying to get the, cheapest vegetables I can find to make salads for days so I could eat for less than $2 a day. Like, dude, not letting that lifestyle inflation creep up as the years ticked on, right? I mean, everybody's got to make sacrifices out there if you want to try to get ahead. That's the bottom line. It just, it's like saying, I want to be, the best basketball player, but, I don't really want to sacrifice and have to do all the work you have to do and, all the work on my body, and it's going to be so difficult and the long practices, I don't want you got to do it. Like, okay, well, then you're not going to be very good, right? So that's the bottom line. In regards to money, you've got to be willing to make a lot of sacrifices or you're not going to be very good. So that's just something to kind of keep in mind there, okay? All right, guys, appreciate you joining me. Hope you enjoyed today's video. Much love as always. If you're looking to apply for access to 1000xstocks.com, you can either go to 1000xstocks.com or you can click the pinned comment down there and apply for access there. Much love and have a great day.